Good morning to our wonderful audience and welcome back to Boutiques on Wednesdays. I stay relatively close to the Union buildings, which is a buzz of activity for the presidential inauguration today. The past few days was a treat for any aviation enthusiast, looking skyward, what with the roar of jet engines and throbbing helicopter turbines. I didn't realize we have so many working flying machines anymore, but we obviously do. So it seems to be, or it looks to be, something very interesting today. Speaking of the flying, the rand and our markets are firming. And just this morning, my colleague Peter Clark shared an article from JP Morgan where they are upgrading South African equities from underweight to overweight. Very interesting. From an oversold position, SA equities are looking good at the moment, but time will tell if this will be a long-term upgrade to overweight or not. We've also seen phenomenal returns from the credit markets, more specifically the BCI Income Plus Fund. And can this continue? People wonder. With that, then, here to give us more insight on what to expect going forward, it's my absolute pleasure to welcome Louis from Fairtree, fixed income manager of the BCI Income Plus Fund. You're all very familiar with Louis. And also joining us this morning is Kobus Potgieter from Southern Cross Capital, here to tell us a bit more on how they manage funds in the Southern Cross Capital BCI Equity Fund and how a hedge fund approach can create investment ideas for the equity fund. Good morning, Louis. Good morning, Kobus. How are you this morning?
Good morning, Eugene. Thank you for having us.
Morning, Eugene.
Fantastic.
Thank you.
Good morning, Louis. Again, gents, thank you for your time. It's really great to have you joining us on Boutiques on Wednesdays. Kobus, I believe you're going to start first. Your presentation's up and running. If you are ready, we are ready for you.
I'm as ready as I'll ever be. Thanks so much for the introduction. Good morning, everyone. This is the first time we are presenting. We are a reasonably new component in the BCI stable, having recently launched a general equity fund. And I thought I'd spend a little bit of time just introducing Southern Cross to those that have not yet been exposed. We are a very hedge-focused niche boutique asset manager. Give a little bit of history and then move on to the two themes that Eugene described for me. So off the bat, we are Southern Cross Capital. Our entire approach is sort of baked into that you employ us as asset managers to manage risk, to guide you through uncertainty, and to always have a strategy in terms of how we aim to achieve a specific investment outcome, and essentially be protected in most markets. That is a very sort of hedge-focused underlying philosophy, but we believe it translates well to long only, and we'll get to that in a second. This is the team, Wilhelm and myself, really the core investment team. We are both ex-nitrogen fund managers. It's sort of a medium-sized hedge fund shop, institution-focused hedge fund shop in Johannesburg, and we went independent in 2017 to start up our own asset management business, and that's essentially the inception of everything you see here today. Christian joined us in 2020 as head of distribution. Somebody to engage with if you need a little bit more information, and if you'd like to understand better how these products can work well within your portfolio. Just in terms of business background, our AUM is sitting at 517. The hedge is the lion's share of that at around 470. The long-only fund, the BCI, Southern Cross BCI General Equity Fund, which we'll be chatting about today, that's quite new. It's only at 47 million, launched in October of last year. Like I mentioned, we launched the operation in 2017. March 2019, we won Fund of the Year in our category. At the time, that was our only product, which was a market neutral retail hedge fund. In 2020, we launched the multi-strat fund, more moderate risk offering, not as low risk as the market neutral. And September, we launched the general equity fund. This is platform availability. As you can see, largely available on most of the platforms. And I mean, as we've all seen, this has become a reasonably easy exercise in terms of commitment and getting onto those platforms. But even the hedge funds have been pretty easy to onboard lately, and they are available on most of the credible platforms. So this is just a better picture of how we position these different funds. The hedge funds, we like to think of as a cautious product, a low equity product, the market neutral fund. The multi-strat fund, more of a moderate risk approach, moderate return. And the long-only fund, obviously being 100% invested into equity, being what we classify as an aggressive long-term investment. So I'm just going to run through this quickly. These are not BCI funds, so Eugene doesn't like me talking about them too much. But this is the market neutral fund, launched in 2017. As you can see, it gives you that cautious type return profile, but with significantly more protection. That's just one of the sort of characteristics of these funds. There is certainly a little bit of direction, as you would find in a CISA cautious fund in terms of equity direction, but the nature of the strategies tend to be quite inversely correlated to the market when we have those down markets. And most of the benefit we get from that is not in these massive upswings in returns, but typically in the downside protection. So as you can see, simply through that drawdown avoidance, this fund has performed phenomenally well, given its risk profile and its very low standard deviation and drawdown profile. The numbers speak for themselves. You can have a look at these later when you look at the presentations. In 2020, we launched the multi-strat fund built around exactly the same methodology, but running more equity exposure in there. We actually found that the two components complement each other incredibly well to give, what from our perspective, even though it's more volatile, it does suffer more drawdowns. It's a much more attractive return profile in the long term. It also speaks for itself. We compare this actually against the high equity category, which is 75% equity, 25%, maximum 75% equity in terms of that peer group. And as you can see, again, the numbers speak for themselves, largely avoiding drawdowns and, outperforming over time. Strategy works quite well, especially compared to those multi-asset categories. And it does the same thing as that market neutral fund, but adds more conviction on the equity side, runs more equity exposure, and it combines to create this very attractive return profile over time. So introducing the Southern Cross BCI Equity Fund. The track record is less than 12 months. I can't really show performance numbers, and it has been very early, but we would like to chat about our approach and essentially how we as hedge fund managers can use that mindset as an example to produce value within the long-only space, and how being corporate structure focused, deep value equity guys, that translates into a rather coherent long-only strategy as well. So I should have mentioned before, but our focus largely is in corporate structure arbitrage. This means we like any situation where there are multiple entry points into the same legal structure, the likes of an INL, INP, Mondi, which used to have 2 entry points. It does still have entry points in the form of listings on different exchanges. Remgro, which had multiple listed assets, PSG, which had multiple underlying assets, and our bread and butter trades were essentially exploiting those situations where one of those components become mispriced. Now, this has allowed us to really become experts over time at dissecting and understanding a balance sheet and understanding where the market is ascribing value and where the market is perhaps missing something. So as a nice classic corporate structure example, something we do actively in the hedge funds would be Anglo American PLC. We have the two major listed assets, which do comprise the lion's share of the value in the underlying at times. And then we have the unlisted assets, which are copper, coal, diamonds, other base metals, and of course the debt at the center, which is something which one shouldn't miss when you're simply looking at something at a holding company level. It's not just these assets less those assets. There's also the debt, cash at the center, other things to consider that complicate the situation somewhat, but it is easy to, or simple at least, to model and understand that structure correctly. So if we looked at the sell-off in the wake of that disappointing production guidance in 2023, and there was essentially a miss on copper production in South America, the market reacted completely disproportionately. And Anglo sold off quite significantly. There was a bit of pressure on the other industrials at the time, but this was completely disconnected, and we were sort of at that turning point in the cycle where the market was quite bearish on all of these industrial metals, and Anglo took a particular pounding in that situation. However, if we strip out the Amplats and the Kumba, which are obviously easy to understand, this is quite a simplified way of looking at. These are custom indices that we build within Bloomberg, and you can see that move on the underlying, even considering the debt sitting there inside of Anglo American itself, stripping out those other listed assets. That move was, totally severe. And this was against the backdrop of that pent up bullishness in copper in particular. So if we were to take the valuation of that ramp, adjust for the other assets and the debt, I know De Beers is in there as well, but that's sort of a bit of, we're essentially getting De Beers for free when this thing is trading cheap enough. Compare that to the global listed peers or something as simple as the COPEX, which is a basket of listed copper producers, you realize the situation was very, very stretched. The market was completely too downbeat. And, worst case scenario, this should recover over time. And best case scenario, some peers might come sniffing around looking for a bargain because there is the shortage in supply of copper with a positive outlook around the whole semiconductor boom that we're seeing at the moment. So how do I express this in a hedge fund? In the simplest terms, I would go along the Anglos, I'd short out the listed assets, and on a proportional basis, I would short out peers that represent that underlying basket to build somewhat market neutral trade and exploit that severe disconnect between Anglo American and the listed peers. In the long only fund, it's largely the same. I go overweight my Anglos. I go underweight Anglo American Platinum and Kumba Iron Ore because, I like the copper exposure. I like how cheap Anglo American is, but Anglo American also provides a cheap entry point into those assets as well. If it's trading at a 30% discount to its underlying valuation, I'd rather enter it at that discount than be overweight those holdings. So I'd underweight those, and at the same time, to isolate that even further, I would underweight the peers. So I would perhaps underweight Glencore, underweight Exxaro, and on that basis, position my portfolio to really try and exploit that disconnect. This trade obviously worked out very well, and we are not resources guys. We are more deep value guys, but the value here was so compelling relative to the peer group. And because one is always somewhat benchmark cognizant, it does create that opportunity to reposition your portfolio based on extreme value being shown in one of these names in particular, when you understand the structure, on that level. And that created a very nice opportunity for us to exploit. And this sort of thing presents itself all the time. RMI, which became OutSurance, was a very nice example. So these corporate structure hedge opportunities do actually provide a lot of value for a long-only portfolio as well. Then the second theme we wanted to discuss was SA Inc. And in our defense, we had to prepare this portfolio last week, and it didn't seem so obvious at the time. In hindsight, obviously, some of my numbers might be outdated, but we wanted to talk about the compelling investment case for South Africa in particular, maybe address one or two of the forward looking, and also the technical reasons why there is quite a bit of opportunity and that this rally could be sustained quite a bit further. In the simplest terms we have here, we've compared to MSCI emerging markets, the JSE All Share, which we already know is full of sort of mega caps, offshore, heavily invested offshore, in any case through Naspers, Prosus, the mining stocks, Mondi. These businesses are not South African, but they do comprise significant components of the local space, the local listed space at least. On the right-hand side, we have the mid-cap index, which is showing even more severe disconnect, even more value. And that is, of course, much heavier in the so-called SA Inc. stocks. So those very South African-focused stocks are looking remarkably cheap. Bottom left, despite being resources heavy, and we know resources stocks tend to not yield as well because they have to continuously reinvest capital into their businesses. The yields have been incredibly attractive relative to the rest of EM, which is already yielding pretty well. So that just shows cheap. We all know this is cheap. This is things we all know. I mean, this horse has been flogged to death. It just demonstrates once again that despite, and as of when we compiled this last week, a lot of optimism being baked in, it seems that there was still a lot of compelling value in South African stocks. The banks in particular, which we are very much overweight. We took an active overweight position in the banks, and it is our most significant overweight sector overall. FirstRand, Standard Bank, Absa, Nedbank, Standard Bank, particularly cheap, we would say, and trading very close to book value. In the case of Absa and Nedbank, below book value, with PEs that are in some cases lower than yields. That is remarkable value. And if the outlook for growth could shift going forward, that just creates enormous opportunity. So just to quickly chat through the reasons why this opportunity, this was last week, but the facts remain the same. We are at peak interest rates, and these assets stand to benefit. EM does stand to benefit, and as the cheapest EM market, when those flows do shift, we expect South Africa to benefit a lot. We believe the Eskom risk is slowly sort of weaning, to a lesser extent Transnet and the port situation as well. Another own goal that is slowly being sorted out, and the signs are definitely there in terms of what we read in the media. The shift is slowly happening, and even the corporates are shifting their outlook there. It does look like some of those pressures will be alleviating. South African businesses have been sort of very resilient and well managed. We've seen Mr. Price go from 70% coverage to over 90% coverage in terms of backup power generation. So all of these investments took up a lot of free cash flow and ate up a lot of profits, but we should see that defensiveness play itself out going forward. And then on the technical side, it's always been a very good proxy to read foreign investments and foreign flows. And whenever foreign flows were sort of outflows were at a peak, there was a good time for the locals to come in and buy South Africa. And valuations were attractive. And when that trend reversed, there would be a kick up in the market. We saw that in 2020. We saw 12 years before that. And this time we had a unique situation where, because of the change in Reg 28, the balanced funds were selling so aggressively that whilst we had these foreign outflows, local outflows were putting a lot of pressure on the markets. And those holdings are, depending on which survey you read, anywhere between 39 and 41% offshore. So we anticipate this positive election outcome and that expectation to cause a reverse in both those flows, locals and offshore, and lead to expansive multiples locally. Yes, there is a lot of uncertainty still. We need to see how this government of national unity plays out, but we believe this priced for failure situation at the very least has to rectify itself, and that already creates a lot of upside. We don't have a cool term like Ramaphoria this time, but in the office, one of my colleagues is taken to calling it coalition commotion. And we believe that, sort of that shifting in outlook, that rebalancing in the outlook, even if it's not as rosy as we all hope, ultimately, we shouldn't be priced for failure anymore. There should be some fiscal corrections, and better governance, and ultimately that outcome should lead to better opportunities locally, more positive outlook for growth and expansions in these underlying valuations. There are a lot of easy wins for the government. Thank you. That's those are the only themes we have to discuss today. And I'll hand it over to Eugene again.
Thomas, thank you very much for that. Insightful indeed. I've got some questions from you. Don't see anything yet from the audience. Louis, if you're ready, you can start sharing. Thomas, if you can just stop share. There we go. Yeah, I can see something coming through, Louis.
Is that up? Is it in?
Perfect. Thanks a lot.
Perfect. Okay, good morning. I'm going to talk to you about the BCI Income Plus Fund, and I'm going to show you why pure credit funds should have a place in broader portfolios. And I say pure credit funds because BCI Income Plus doesn't carry any interest rate risk or currency risk in the fund. So there are no long-term bonds or unhedged currency in the fund. Its only goal is to extract a credit risk premium from the assets that it invests in. So I'll start off by talking about credit as an asset class, and why it's a source of risk premium that shouldn't be ignored, especially since it's uncorrelated to other asset classes. I'll show you in the performance slides. I'll go through defaults or credit losses and how they can be managed and why they shouldn't be feared. We'll look at the short-term and long-term performance of the fund, and then what I think you can reasonably expect from this fund going forward. So credit as an asset class, we have a look. This is the iTraxx Crossover Total Return Index. It's an index of the 75 most liquid European sub-investment grade names, all equally weighted. Beg your pardon. It's reconstituted every 6 months. This is going back to March 2006 when the index was started, and I've plotted against 3-month Euribor. These are quarterly numbers all the way up to the end of May. And the reason I'm using the iTraxx or European index, first is because we don't have the same level of data locally. Secondly, we do have about 35% of this fund in hard currency assets, and it's a very good proxy for global credit. So you can see it's had a healthy realized credit risk premium of 4.46 per annum over the time period over the total return from 3-month Euribor. So it's been a pretty good investment, global credit. Now it's probably easier to look at this on a as iTraxx crossover against Euribor plus 446 basis points, the total return. But you could say, well, it depends on what your starting point is. But even if you went and picked a point where crossover was at a peak, as it was on 31st of March 2015, where you see the arrow, you still would have generated around 284 basis points over the 9 years since then. So over the 17 years from 29 March 2006 to March of 2024, it's given you 446 basis points. Over the last 9 years, 284 points. So it's a good source of uncorrelated risk premium that can be tapped. But the most powerful thing about it is that it is uncorrelated to other asset classes. And in fact, it's not even correlated to short-term policy rates. This is a chart of credit default swap credit events or defaults versus the Fed funds target rate and the ECB main refinance rate. And the first thing that's pretty clear is that there's a very strong correlation between central bank policy rates. That's the green and the blue line. And you can see that notwithstanding the fact that we had this massive kick up recently in both the Fed and ECB rates, and the fact that they've remained at elevated levels for a prolonged period of time, we haven't seen an increase in credit events. In fact, they've been conspicuous by their absence. There have been none this year. And even if we go back recently, when we look at 2022, there were 10. There was only one American corporate default in there, issuer default. The rest were all Chinese property companies, and there was Ukraine and Russia and so on. And then last year there were 5, of which there were 2 American names and 1 European name, and the balance was Ghana and another Chinese property company. So we were exposed to, over the last 2 years, 4 of these names. We took credit losses on them. Again, they were via indices of more than 75 names. So at the portfolio level, they were meaningless. But also, what's important to note is even when interest rates were practically at zero, there was you would have expected a big reduction in credit events where there wasn't. So no correlation between this even and between defaults and policy rates, in fact. If we now compare that to the term risk premium that you would have realized over the same period from local bonds represented by the Albee Total Return Index, again, versus 3-month JIBAR, which is the local 3-month bank NCD rate, total return obviously is given you over the same period 112 basis points, or 1.12%. So this is just to show you that credit as a separate asset class is a valuable building block to include in broader portfolios. It's a source of risk premium that shouldn't be ignored, and you can take advantage of it. And this fund has done that over a long period of time now. So just to go on to credit losses, running a credit fund, we get so many questions about credit loss and what about defaults and so on. And investors seem to view defaults or permanent write-down of capital as different to mark-to-market losses. We don't view them any differently. Losses are losses in our book, but we believe that we can manage these. The theory is obviously that yes, you're in a credit fund, you're going to suffer credit losses, but a net of all of these defaults, you're going to end up with positive alpha. And the way that you manage these credit losses is by diversifying your portfolio firstly as much as possible, and then sizing positions appropriate. So when they do default, they're not meaningful losses at the portfolio level. So it's akin to writing insurance. In fact, it's exactly what we're doing. We're writing insurance. We want to write a lot of diverse risk in small size. So when it does happen, which it inevitably will, it's not something that's crippling to the portfolio. Another thing we do is we make sure to price these instruments as correctly as we possibly can before we put them in. And then when they're in the portfolio, as far as possible, make sure that they're marked correctly, especially if instruments are impaired. If an instrument's impaired, we will mark it down immediately and quite aggressively. And obviously, it's much easier to do if your position sizing is correct. If it's a small position, much easier to write it down aggressively than if you're carrying a massive position. So we've never, in fact, we've never actually side-pocketed any impaired assets at all. In all the time we've been running credit funds, that goes back to 2008, we don't believe in it. So the performance numbers that you see in a fund are true numbers. They're net of all defaults that have been suffered by the fund. Fund performance is an important part. This is the long-term performance from the BC Income Plus Fund since its inception, 1st of April 2014. You can see it's generated 146.22% over the period, or 9.2% per annum. This is the orange line you see here. So notwithstanding the fact that it's a lot less volatile than bonds and equities, this is the green line. It's the Albee Total Return, and the blue line is the top 40. The red one is Steffi. So notwithstanding the fact that it's a hell of a lot less volatile than bonds and equities, it's outperformed both the Albee Total Return and the top 40 Total Return over this time period. It does carry some volatility. It's quite low, in the region of around 2% or below. It has periods where it will suffer, drawdowns, as we saw in March of 2020, and again in 2022, when credit spreads blew out. But it tends to come back quite quickly. And this is 10 years of data. These are calendar year returns. So 2023 was a really good year for the fund. It generated 13.38%, which was 495 basis points, or 4.95% over 3-month Steffi Composite. Our target there is Steffi Composite plus 3%. So easily achieved that target. outperformed bonds and equities as well over the period. And then 2024, it's been a good start. This is to the end of May, 5.02%, again ahead of, well, until the end of May, we were ahead of equities and bonds, ahead of the Albi total return on the top 40, and 1.45% ahead of STEFI. So it bodes well for achieving the 3% target for STEFI over the calendar year. Previously, I mentioned correlations and how there isn't a correlation between credit and other asset classes. This is correlation between the BC Income Plus Fund, the top 40 total return on Albi. You can see against the top 40, 0.36, and against Albi, 0.42. So no correlation to those asset classes, which is why it's a good building block to have in broader portfolios. These are fund rankings. This fund is in a multi-asset income fund category. I think over 1 year, there are 116 funds in the category, far fewer over 10 years. I think there are 45 there. But you can see the fund has been lucky enough to have consistent performance over a very long period of time now. So it's, as at the end of May, it was first in its category over all of those time periods, 1 year all the way up to 10 years. So it's had a good run of consistent performance over quite a long time period from now. So that's all well and good. What's the outlook from the fund from here? So this fund generates its returns from two main components. It's base rates, which in our case is the JIBAR, 3-month JIBAR, and the second is the credit spread that we earn over and above that JIBAR rate. And that's just leaving sort of movement in credit spreads aside for the moment. This is the 1-year interest rate swap rate. So to give you an idea of what the market is expecting the base rate or JIBAR to do over the next year. And this is the sort of compounded return expected from 3-month JIBAR going forward over the next year. That's at 8.15%. We then have a look at the second component, which are credit spreads. This is again the iTraxx crossover index, 75 most liquid European sub-investment grade names. And this is an unfunded index. So these are actually spreads over 3-month Euribor. And you can see spreads have compressed by about 100 basis points from the sort of average levels that we were achieving last year. Locally, spreads have remained very tight. Even throughout 2023, they remained very tight. So the fund's actually quite liquid at the moment. We've chosen not to risk up the fund with these, with spreads being compressed. And we don't want to add risk aggressively to the fund at the moment. We will do as spreads widen, but nonetheless, we're still achieving a weighted average spread on the fund, which is north of 200 basis points. So if we put all of this together, market implies that we'll have a cut in the repo rate of 40 basis points over the next year. It's a little bit more now since yesterday. It's about 50 basis points now and about 75 over 2 years. So rates are declining. It's unlikely we'll achieve the performance that we achieved in 2023 in that sort of environment. The domestic spreads are still tight. Hard currency spreads have tightened a bit, but we're still generating, as I said, in excess of 200 basis points. So if we add these two together, the fund should still be able to generate double-digit returns over the next year. This is, of course, assuming that the market's correct in its assumption of where interest rates will be over the next year. But still, it's still going to be a positive outcome for the fund. Thank you very much.
Louis, thank you very much for that. Insightful indeed. While I've got you on the line, a couple of questions. I don't see anything from the audience yet. Just a reminder, if you do have questions, that Q&A bubble is still there. Louis, just looking at your returns, I mean, you've made mention over the past 12 months, just shy of 14%. I mean, that's absolutely phenomenal. May was indeed a strong month as well, 1.22%. So really good returns, and I think investors are really spoiled in your fund, even since inception. But here's the question. I think this is what everybody's asking, and I wouldn't say worrying about, but trying to understand the way forward. You said double-digit returns over the next 12 months, and I'll park it at that. But your fund, you've got SA credit, you've got foreign credit, more specifically European credit. European credit sitting at roughly about 32%, if I've got it right. Which component was the strongest attributor to performance over the past 12 months?
Definitely the offshore component. I mean, that's driven most of the returns, and we got a little bit of a boost towards the end of last year as well because the spreads compressed a bit. But we were able to, I mean, we were, with spreads north of sort of 300 and 350 basis points, we're able to reinvest maturing assets at quite nice spreads. Whereas domestically, you're hard pressed to find, anything sort of approaching those sort of levels unless you're taking a lot of risk. There's not a lot of issuance locally because obviously the economy has been pretty slow. Not a hell of a lot of demand for capital. So we've tended to increase our offshore component, and we'll look to up that again if those spreads start to widen a little bit.
Right. Question from the audience from Tavonga, and sticking to credit spreads. I mean, SA credit spreads are very thin at the moment. And Tavonga would like to know, how do you expect credit spreads to normalize in SA over the coming year or two?
Look, I'm not going to hold my breath, but I think we need to have some economic growth and some certainty where we get, people start to commit capital to long-term projects, so we get more issuance. Currently, there's a bit of a hothouse effect, and I think what's happening here is a lot of funds chasing a few assets here. The banks also competing in that space now as well. So it has put a bit of a cap on domestic credit spreads.
Another question from the audience. My understanding of credit cycle is that the liquidation cycle lags the positive GDP growth. How will you manage the risk in a year ahead as the economy improves?
Look, we don't, you gather from the way that we manage the fund, we're not in the business of predicting anything. We don't predict interest rates or currencies or the credit cycle.
Not that we can.
Yeah, exactly. Well, we don't believe that we're any good at it. So the aim is to be fully invested at all times. We may not up risk credit, by taking, as spreads compress, but the aim is to be fully invested in credit at all times. And as you've seen, there's little correlation between interest rates and credit. So it's difficult to figure out where you are in the cycle.
Definitely. Lou, you mentioned risking up the fund. It's very difficult from a typical fund fact sheet to understand exactly what the holdings are, because on a look-through basis, it's not always 100% accurate. But if you talk about risking up the fund, especially in the SA context, are you then sitting on more cash, just normal entities and BAs? What I'm looking at roughly at about 18%. Is that what you're referring to if you're talking about risking up, is redeploying some of that cash as credit spreads opens up again?
Correct. So we've got a lot of liquid assets. We've got T+0 liquidity, like NCDs, floating rate notes. They don't really help our cause because they don't pay us much. These are sort of 50 to 80 basis points. Risking up in this case would be, obviously, if we found attractive assets locally that were paying us enough, but more than likely will be to increase the offshore exposure, and obviously hedged, currency hedged on that. That's what we'd look to do.
100%. Another question from Tavonga. As a building block with meaningful foreign allocation, are you fundamentally closer to SA equities than you are to SA bonds? Or have you different way of highlighting key differences between your building block versus SA bonds versus SA equity?
And that's a little bit of a difficult one. There's a little bit of to both. There's a little bit of correlation, in terms of the offshore component. When you're in a risk-off environment, you'll see that offshore credit spreads will widen, local bonds will sell off, and often local equities will also sell off. So there's some correlation there. Whether it falls closer to the correlation falls closer to equities or bonds, I'm not too sure. There isn't any real correlation over time, but in a global risk-off environment, that's what tends to happen.
I fully get that. And I mean, you did make mention that you want to increase your foreign component, sitting roughly at about 32 at the moment. What will make you move to the upper limit of 45?
If those hard currency spreads widen appreciably. So generally what we'll do is, as they widen, we'll say, look, currently they're sitting at about 320. We'll say, look, we'll take a bit of, we don't know how wide these spreads go. So at 350, we'll take a bit, take some more, 380 bips, 400, and so on. That's generally the sort of process that we follow.
Yeah, as part of a risk management process. In case the audience missed that or don't know it by now, the foreign component, obviously the currency risk, totally hedged out in the BCI Income Plus. If you want the naked exposure, for a lack of better words, you can always look at the BCI Fairtree Income Plus feeder fund. We do have currency exposure as well, but for obviously in international portfolios. Louis, thank you. Cobus, if I can maybe step over to you, just a couple of questions very quickly to try and understand your portfolio management process a bit better. So the Southern Cross BCI Equity Fund is the SA Equity General Fund. You do have foreign exposure in the fund. Your foreign exposure at the moment roughly sitting at about 10-11%. But I see your foreign exposure you get via ETFs, MSCI and S&P 500. The sense out there normally is that S&P 500 are a bit expensive. You did mention you've got a value bias approach. I wouldn't necessarily box you in a deep value box, but maybe just speak to why the relatively low global exposure, if I could compare it to similar or other SA equity general funds, you tend to be a lot lower and higher on SA equity. Does that speak to your valuation process, or how do you get to that answer?
Thank you, Eugene. Yes, absolutely. That speaks to sort of our current tactical positioning. To give you an idea, we would have preferred, our strategic asset allocation approach would have probably had us at least 30% offshore on average at any given situation. Obviously, if we were bullish offshore securities, we would move that higher, or bearish local. This is overall an active call. We are heavily overweight South African stocks because we see a lot of the relative value there. The reason for those ETFs, to be honest, that's just one of the friction points of launching a new fund. The capital gets bled in quite slowly, and it's quite difficult to construct a portfolio, with smalls initially. So we bled that into those ETFs initially. They were Section 65. There was no friction. And once we could get that offshore access in place, we've actually been slowly switching that exposure into more specific picks as and when we find them to be attractive. So you'll find our other offshore picks. We've got, again, some deep value, and specifically in the defense sector, which is a sector we like to play, which there is no way to get exposure locally. We've got some Rheinmetall, we've got some Thales. That's a sector we've liked quite a lot, given the build-up into the likely rearmament of the North Atlantic Treaty Organization nations. That's a theme we like to play, and those stocks were particularly cheap and yielding well as well. So that's where we have a lot of our exposure. Back to the local situation, you'll find on our local components, if I square up that 88% local and look at that as my SA allocation, we are over 5% overweight the financials. So that is, again, an active call, looking for that deep value, and taking the view that there should be multiple expansion in those banks in particular.
Let's stick to financials. I mean, a lot of different views on Capitec. With some managers will still, say that Capitec is a value stock. if you ignore the PEs. You've got no Capitec. Why is that?
Valuation. We like the business a lot, make no mistake. And we have been in Capitec at times when we do see that value there. But, you know, these very stretched valuations are quite uncomfortable for us to stomach at any given moment, unless we feel there is something, you know, some material upside that the market is missing. Obviously, I wish I had some Capitec in there as well over the last week or so, to be perfectly honest. And there is still quite a lot of runway in terms of the outlook for that stock, doing phenomenally well in terms of the transactional business specifically. Some risks, you know, on the lending, but ultimately we love what they're doing on the transactional side overall. I think the market is perhaps pricing perfection on the business banking side, which is I think more uncertain to materialize.
A lot to do with the current valuations. Getting a bit more into your thinking, I mean, coming from a hedge fund background, you spoke about arbitrage being your main strategy. Again, in a lot of general equity funds, if somebody holds a NASPAS, they'll typically hold a process as well. You've got no process that I see. Why NASPAS, no process?
Yeah, you've nailed it on the head. So if I am actively exploiting that arbitrage situation where I see the Naspers relatively undervalued compared to process with more upside in my hedge fund, I'm far more likely to be expressing that in the form of overweighting the Naspers in the long-only fund. And we will reasonably actively switch those situations as well as they ramp up. So that will, again, was an active call where we see significantly more upside in the Naspers, significantly potential value unlock, and we will frankly switch that around. It is our preferred entry point into 10 cents. Obviously, we wouldn't hold that directly given the discount opportunity. And Naspers at the moment is just showing substantially more. But to give you an idea, on the hedge fund side at the moment, we have quite a nice ARB going, market neutral ARB, where we are long the Naspers, short the 10 cents in Hong Kong, and also hedging back that underlying currency exposure.
I think Tanya's giving me a hiding here, but venturing a bit more into your hedge fund thinking and the hedge fund space. Question again from Tavonga, one of the audience members. The first question, may you please explain how you build up gearing in a multi-strategy fund? Very short answer.
Essentially, we do this on an asset allocation level. The beauty of a multi-strat fund, and it's very abstract to understand, is that we can invest the same rand more than once. So I can have 75% equity exposure and maybe a 90% bond exposure because I can be short cash. So I can play a little bit of duration in my multi-strat fund. So it does tend to, those, again, the asset classes we have within the fund do tend to hedge each other very naturally. But we do, on an overall portfolio value at risk approach, of course, we contain the downside in that situation, and our shorts also provide a lot of protection on a gross level. But ultimately, you'll find that asset allocation on a net level will translate very similar to what you'll find in a moderate aggressive balanced fund.
Sticking to bonds, if I look at your asset allocation, you've got some dry powder in domestic cash, roughly about 12%. Why then not SA bonds in the long-only fund?
Yes, it is a general equity fund. We've actually deployed that capital already. It just needs to settle. So we do have that underlying exposure. We've been buying equity in those with those inflows.
And if I gather from your presentation, stocking up a bit more on SA Inc., right?
Yes, absolutely. In fact, I guess another type of arbitrage we do is corporate action, where we find a situation where there's a secondary offering, a rights issue. We find cheap entry points into stocks that we like. We were very active last night in the Remgro book build for momentum, and we actually took a significant slug. And this is one of the first times that we've been able to do that same sort of trade for the general equity fund that we were doing for the hedge funds as well.
It's been very insightful, getting a little bit more into the thinking of Southern Cross and how you apply your mind when managing a long-only fund. And obviously, you've got the 2 hedge funds as well. I'm going to park it there with this very last question to Louis, also from the audience. I think I know the answer, but just remind us again of duration risk management within your portfolio.
No duration in a portfolio
No
at all.
duration.
All FRNs, so all floating rate notes resetting every 3 months. So no long-term bonds, so no interest rate risk in the fund at all.
And we've seen it again with if bond yields move out, typical income funds do feel it, but you don't see it in the BCI Income Plus fund exactly because of that reason. Gentlemen, the clock caught us. It's been very insightful indeed. I'm sure there's a lot more we can discuss on your portfolios and your funds. Kobus, I see you being joined by Christian as well. You did make mention of that. If you want more information on Southern Cross, please get hold of Kobus or Christian or any of the BCI sales team, and we'll gladly direct you to either one of them or share the information. Obviously, the session, like all the other sessions, are being recorded. We'll share the presentations. Louis, also thank you very much for your time. Very familiar with your fund. I see Ryan also on the call. If you want more information on the Fairtree or the BCI Income Plus Fund, please make contact with us and we'll get you in touch. Quick reminder, next week, Wednesday, the 26th of June, we've got a multi-asset fund discussion focusing on current asset allocation views, panel discussion with North Star, Investec and Sasfin. And we look forward to seeing you again next week, Wednesday. To our participants, Louis and Kobus this morning, thank you so much. And to our lovely audience out there, thank you for your continued support. We're always very grateful, and we'll see you soon. Thank you.
Thanks, Eugene.
Thank you, Gene.